So this video and probably one more are the videos on chapter 36, which is all about monetary policy and the importance of interest rates. So we're talking about the real rate of interest here. So we had a live class last time on Thursday, and I'm going to review the stuff that we went over at that point. So if you missed the class, here's your chance to see what we covered. Of course, you need to read the book thoroughly to know all about it. And then we're going to talk about the tools of monetary policy. We talked about two or actually three of them on last Thursday in our live class. I'll review them very briefly, and then we'll get to the open market operations, and that may wind up being in the next video. Let's see. So what we talked about in chapter 36 is the money market. Monetary policy involves what we call the money market. And the money market has the supply of money as the horizontal axis. The supply of money, we'll call it MS, on the horizontal axis. And the vertical axis is the real rate of interest. I'm going to be using lowercase r. Your book has gone to using lowercase I as the pure rate of interest. It is the real rate of interest. I'm going to put an r there. Lowercase r, lowercase I, basically the same thing, the rate of interest. Okay? All right. So we talked about the demand for money during the live class last time around, and we know that there's the transactions demand, which is just based on the size of the GDP and the habits of the people involved in the economy, and it's a vertical line somewhere to the right of the origin. So somewhere over here, vertical line is the transactions demand. I'm just going to put a dot up here to represent that transactions demand. And from there, we're going to go down. That is the total demand for money, which is the transactions demand, plus the asset demand. At lower rates of interest, people don't want their money in risky investments because the return isn't very high. They'd rather have their money in cash or in a checking account in their bank. So they're going to hold the money as money rather than invest it. Lower rate of interest, more people want to hold on to their money. The demand for money is very high. Okay? The supply of money, like I said in the live class, is simply the amount of money that the Federal Reserve has supplied. It's a vertical axis at whatever the amount the Fed has supplied is, low amounts to the left, large amounts to the right. Currently, we're way out here somewhere. In fact, we're probably even further out than that. That's the supply of money, and this is the money market. The money market, or the AP exam may refer to it as the market for money. And that, of course, is the equilibrium interest rate, real rate of interest. We'll call it R1 in this situation. Okay. All right. So the real rate of interest determines the investment demand, if you recall. Okay, that real rate of interest. So I'm going to use a different color, get the blue marker out here. Remember that we had the investment demand curve, the ID, investment demand curve, which was, again, the real rate of interest on the vertical axis, only this was the total amount of investment in the economy. Investment is one of the components of aggregate demand. C plus I plus G, government spending, plus net exports. So the investment demand curve was a downward sloping ID curve. And the real rate of interest basically determines the amount of investment in the economy. There's I1. That's the amount that I is going to be in the economy. So clearly, if the Fed moves the supply of money further to the right, interest rates drop, businessmen borrow and spend more money, and it increases aggregate demand, pushes aggregate demand to the right. Now, if the economy is already operating at a good equilibrium, at full employment equilibrium, then pushing the aggregate demand curve to the right is going to cause inflation. And that inflation is going to cause the short run AS curve to shift back to the left because cost of labor and raw materials goes up, inflation, and we wind up just moving at the full employment level of output upward. And I'm not drawing that graph on the board right now, but hopefully you have it in your mind. Okay. And so if we expand the money supply and increase the amount the businessmen are spending when we already have full employment, we just cause inflation. Not what we want to do. So sometimes the Fed wants to contract the money supply, bring it back to the left, raise the rate of interest, reduce the amount of investment spending by businessmen, and stave off or slow down inflation. So that would be contractionary policy. All right, how does the Fed manipulate the supply of money to move to the right or to move back to the left? And that is where we get into the tools of monetary policy. Now, your book has a section on pages 720 and 721 on the consolidated balance sheet of the Federal Reserve banks. You can read through that. We're not going to refer to it very often. Just know that the Federal Reserve holds a whole lot of securities, government bonds, mostly T-bills, T-notes, and T-bonds. And that is the securities that they hold. They lend money to banks. Those are all on the asset side. And then there's other assets that the Fed holds that your book doesn't even bother mentioning. Another $240 billion worth of them, apparently, back in 2016. On the right-hand side, the liabilities of the Federal Reserve are mostly the reserves of commercial banks and the Federal Reserve notes that are outstanding. And then, of course, the federal government has a bank account at the Fed, which is what they write checks on to pay for government services, services that the government purchases from private individuals or companies or corporations or whoever it may be. So I went over 2 or 3 of the tools of monetary policy. I told you in the live session that traditionally we've talked about 3 tools of monetary policy: open market operations, the reserve ratio, and the discount rate. A 4th tool was developed after the financial crisis in 2008, and that is interest paid on reserves in the Fed. So we covered 3 of those tools of monetary policy. We covered already the required reserve ratio. If they raise the reserve ratio, okay, so the first one we talked about was the reserve ratio. If that goes up, it causes the money supply to go down. Raising the reserve ratio reduces the amount of excess reserves. When you reduce the amount of excess reserves, banks can't make as many loans, and the money supply falls to the left, okay? So that would reduce it. Increasing the reserve ratio, reducing the reserve ratio would cause the money supply to increase, okay? So that was the reserve ratio, okay? They can either do this or this. This would be contractionary policy, raising the reserve ratio. This would be expansionary monetary policy, lowering the reserve ratio and expanding the money supply. The second tool was the discount rate. And that's the rate that the Fed charges banks to borrow money from it. If the Fed raises the discount rate, banks will borrow less money from it. That means they have less in excess reserves, and it causes the money supply to shrink, money supply down. So increasing the discount rate would reduce the money supply. That would be contractionary monetary policy. Reducing the discount rate, banks would feel more free to borrow money from the Fed, expand their excess reserves, make more loans. That would cause the money supply to increase. So those are the 2 of the main things that you have to know. Then the third one is the new tool of monetary policy: interest on reserves. And if the Fed raises the interest rate on reserves, that will cause the money supply to decrease. Because if they raise the interest rate on reserves, banks want to keep their excess reserves in their uh, on account. They don't want to lend those excess reserves out, so the money supply goes down or stays down. And if we reduce the interest rate paid on reserves, banks say, you're only going to give us 1 or 2% on the reserves we hold. We can lend the money out to customers and expand the money supply and make a lot more, we'll gain a lot higher rate of interest on that. So lowering the interest paid on reserves will cause the money supply to increase. So you have to know those things just kind of automatically. You should make these notes for yourself. You should have your own set of notes on this stuff, and then you memorize it so that during the test you know it immediately, what's going to happen here. So at this point, I'm going to stop this video, and the next video is going to be on open market operations.